Wall Street just experienced its most explosive rally in nearly a year. The Dow Jones surged over 100 points in a single session. The S&P 500 posted its biggest one-day gain since May 2024. But here's what beginner investors need to understand. This wasn't just random market euphoria. This was a textbook example of geopolitical risk premium compression. And if you don't understand this concept, you'll keep getting blindsided by market volatility. Let me break this down in a way that Wall Street analysts explain it to institutional clients. First, what actually happened? Reports emerged suggesting both the US and Iran are seeking an exit ramp from escalating conflict. President Trump reportedly signaled a desire to de-escalate tensions. Iranian officials hinted at diplomatic openings through back channels, and the market immediately repriced its risk assumptions. Now here's the critical concept you need to internalize. When geopolitical tensions escalate, markets add what's called a risk premium to asset prices. Think of it like an insurance surcharge. When your neighborhood has more break-ins, your home insurance premium goes up. Same principle applies to stocks during war or crisis periods. Investors demand higher expected returns to compensate for increased uncertainty. This manifests as lower stock prices across the board. It's not that Apple or Microsoft suddenly became worse companies overnight. It's that the probability-weighted scenarios now include more negative tail risks. Potential oil supply disruptions, global trade route closures, cyber warfare spillover effects. All of these get mathematically incorporated into valuation models. Now when peace signals emerge, that risk premium compresses rapidly. The insurance surcharge gets removed almost instantly, and prices snap back toward their fundamental valuations. This is why you saw such an explosive one-day move. Markets weren't necessarily pricing in guaranteed peace. They were pricing in a reduced probability of worst-case scenarios. Let me give you a concrete historical parallel. During the Cuban Missile Crisis in 1962, the S&P 500 dropped nearly 7% in days. When Kennedy and Khrushchev reached a diplomatic resolution, markets recovered almost all losses within weeks. Same pattern during the 1991 Gulf War. Markets tanked when Iraq invaded Kuwait in August 1990, but they bottomed literally the day coalition forces began Operation Desert Storm. Why? Because the worst uncertainty, not knowing what would happen, was replaced with a clear military outcome. This is the paradox beginner investors struggle with. Bad news with certainty often beats uncertain news, even if potentially good. Now let's talk about what this means for your actual investment strategy. First critical principle. Do not try to trade these geopolitical headlines. The institutional algorithms that moved markets today execute in microseconds. By the time you read a headline on your phone, high-frequency trading firms have already repositioned billions. You will consistently be late to these moves. Instead, use a framework called crisis period dollar cost averaging. Here's how it works in practice. During periods of elevated geopolitical volatility, identify quality assets that are statistically oversold. Several Wall Street analysts use that exact term this week, severely oversold. This means technical indicators like the relative strength index are showing extreme fear. It means institutional sentiment surveys are at multi-year pessimistic extremes. These are the conditions where disciplined accumulation historically outperforms. Let me give you specific examples to research, not as buy recommendations, but as educational case studies. During geopolitical crises, defensive sectors typically outperform. Consumer staples, companies like Procter & Gamble, Coca-Cola, Costco. People still buy toothpaste and groceries during wars. Utilities, companies providing electricity and water services. These have regulated revenue streams largely insulated from geopolitical shocks. Healthcare, pharmaceutical giants like Johnson & Johnson or Pfizer. Demand for medicine doesn't disappear during international tensions. For ETF investors, research vehicles like the Utility Select Sector SPDR, ticker, or the Consumer Staples Select Sector SPDR, ticker XLP, or the iShares US Healthcare Providers ETF, ticker IHF. I'm mentioning these purely as starting points for your own due diligence. Now here's the advanced concept institutional investors use. They employ what's called a barbell strategy during geopolitical volatility. One side of the barbell, ultra-safe assets like short-term treasury bills. The other side, high-conviction long-term equity positions in quality companies. Nothing in the middle. No speculative bets, no over-leveraged positions, no panic selling. This allows you to maintain liquidity for opportunities while staying invested in structural winners. Companies like Microsoft, which just reported strong cloud growth despite macro headwinds, or Visa and MasterCard, which benefit from the long-term digitization of payments regardless of geopolitical noise. Now let's address the psychological trap that destroys beginner portfolios. It's called recency bias. After a 1,100-point surge, your brain wants to believe the crisis is over. You feel euphoric, you want to chase the rally. But statistically, geopolitical de-escalations are rarely linear. Peace negotiations involve setbacks, miscommunications, and political posturing. The Iran situation could easily re-escalate next week. This is why institutional investors use probability-weighted scenario planning. They don't bet on a single outcome. They construct portfolios that can withstand multiple different futures. A portfolio that performs reasonably well if tensions escalate further, and also captures upside if peace prevails. This is the essence of risk management. Now let me give you a specific action framework you can implement today. Step 1. Audit your current portfolio allocation. What percentage is in high volatility growth stocks versus defensive positions? If you're 100% in speculative tech or crypto, you have no shock absorbers. Step 2. Establish a cash reserve equal to 6 to 12 months of living expenses. This is non-negotiable for beginner investors. It prevents you from panic selling investments during drawdowns. Step 3. Research low-cost diversified index funds as your portfolio foundation, something like the Vanguard Total Stock Market ETF, ticker VTI, or the iShares Core S&P 500 ETF, ticker IVV. These give you exposure to the entire market without single stock risk. Step 4. Use limit orders, not market orders, during volatile periods. A limit order lets you specify the maximum price you'll pay. This protects you from getting filled at terrible prices during flash moves. Step 5. Commit to a systematic investment schedule. Every 2 weeks or every month, invest a fixed dollar amount. This is called dollar cost averaging. It removes emotion from the equation. You buy more shares when prices are low, fewer when prices are high. Over decades, this statistically outperforms trying to time the market. Now here's the critical disclaimer you need to hear. I am not a licensed financial advisor. Nothing in this video constitutes personalized investment advice. Every investor has different risk tolerances, time horizons, and financial situations. Before making any investment decisions, consult with a qualified financial professional. Do your own thorough research on any security or ETF mentioned. Past performance never guarantees future results. Geopolitical situations are inherently unpredictable. What I'm sharing are educational frameworks, not predictions. The goal is to teach you how institutional investors think about risk, not to tell you exactly what to buy or sell. Now let's zoom out to the bigger picture. We're potentially entering a period of higher structural geopolitical volatility. US-China, tensions over Taiwan. Russia-Ukraine conflict still unresolved, Middle East instability, climate-driven resource competition. This means the investment playbook from 2010 to 2020 may not work going forward. That era was characterized by low inflation, low rates, and relative geopolitical calm. The new era likely involves higher inflation volatility, more rate uncertainty, and persistent geopolitical risk premiums. This doesn't mean you shouldn't invest. It means you need to be more thoughtful about diversification, more disciplined about risk management, more focused on quality companies with pricing power, companies that can pass inflation costs to customers, companies with global supply chain resilience, companies with strong balance sheets that can weather credit crunches. Think about Microsoft's cloud, infrastructure, or Costco's membership model, or Visa's network effects. These are structural moats that persist regardless of geopolitical headlines. Finally, let me leave you with the single most important mindset shift. Volatility is not the same as risk. Volatility is price fluctuation. Risk is permanent loss of capital. If you have a 10+ year investment horizon, short-term volatility is actually your friend. It creates buying opportunities in quality assets. The investors who built generational wealth bought aggressively during the 2008 financial crisis, during the 2020 COVID crash, during every major geopolitical scare, not because they were reckless, because they understood the difference between temporary price dislocations and permanent value destruction. So when you see a 100-point surge like today, don't just react emotionally. Ask yourself, what risk premium just compressed? What assumptions did the market just revise? And how does this fit into my long-term systematic investment plan? That's how you build wealth in volatile markets. If you found this framework valuable, subscribe for more institutional-grade investment education. And remember, the goal isn't to predict the future. It's to build a portfolio resilient enough to thrive across multiple possible futures. That's the Wall Street playbook. Now you have it too.